Hello, and welcome to Own Your Retirement. My name is Albert Lalonde from Kaizen Financial Group. If you'd like more information about what you hear during our show today, give us a call at 586-752-7008 or visit us online at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen. And while on my website, click on the podcast page to check out past shows and to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. Okay, I've always loved those TV crime shows that say they're ripped from the headlines, and it's a clever bit of marketing that never fails to completely suck me in a bit. So, using that as inspiration, today's show is ripped straight from the financial news headlines. We'll focus on two topics: what the current tariff landscape means for you, and also how to manage your 401k during the current bout of stock market volatility. But before we take a dive into the financial news, let me introduce my co host, Tony Shore, who is a well known financial news junkie and is therefore undoubtedly probably excited for today's show. Hey, Tony, how are you doing, buddy?
Yeah, you know me well, Albert. I am a news junkie, and lately, of course, it's been financial news. In fact, buckle up, Buttercup. The tariffs, the markets, thought we'd play that. It's been crazy out there. And I've
Yes.
been reading all these articles. Of course, you can't look at your phone or turn on the TV or go online without hearing news about the tariffs, about market volatility, speculation. So I think that this is a really good topic you've got for us today, and it is ripped straight from the headlines, the tariffs, the market volatility. I'm fired up for today's topic. But first, how have you been, Albert? Are you doing okay?
Doing well, despite, it's already in the second week of April and woke up with some snowfall this morning. So I'll be
Oh,
happy when this cold spring is done.
yeah, you and me both. We had it first, and then a couple days later, it always hits you. So,
Yes,
yeah,
yes.
yeah, it's not fun. I can't wait for spring. Hopefully, it
Yep.
will finally arrive. So, where do you want to begin our talk today about tariffs, about the markets?
Yeah, let's refer to a CBS News article that Trump announces 25% tariff on foreign-made cars. In fact, on March 26th, President Trump announced a new 25% tariff on vehicles and auto parts imported into the U.S. It's the latest move in his push to strengthen American manufacturing by using more aggressive trade measures. Now, he said the tariffs will go into effect, well, April 2nd. And with the U.S. beginning to collect those duties the very next day. So, according to the president, the new import taxes could bring in somewhere between $600 billion and $1 trillion over the next 2 years. Now, that said, some officials within the Trump administration are offering a more cautious outlook, estimating the tariffs could generate closer to $100 billion in new revenue.
Wow. Yeah, and I thought I'd put up a few notes for our viewers,
Hmm.
and they can see some bullet points there as we talk. But you're right. It is going to there are some positives. It is going to raise some revenue for the United States, but it's also going to raise the price of goods more than likely. And I think a lot of people out there who were thinking about maybe buying a new car either rush to do so, or maybe they're going to wait until the situation has more clarity, because it looks like, especially with a 25% across the board tariff on all cars coming in or parts, which is a lot. I mean,
Yeah,
even US companies that make cars get parts and have cars made overseas or in Mexico.
right.
So yeah, that's a good point. Hopefully the situation will get some more clarity.
And only time will tell, Tony. I mean, just like the little chart you put up there, the main important part is who absorbs the tariff. Is it the importers, the exporters, or ultimately the consumers? And
Right.
that's the worry right there is going that it falls all the way down to us.
Right.
Um, but you have to understand, Trump, he's doubling down on his goal to make interest on auto loans tax deductible, but with the catch. The deduction would apply only to cars made in the US. Now, here's the thing: tax deductions like this usually benefit high. Most Americans take the standard deduction. So for lower and middle income households, this change likely wouldn't move the needle much, Tony. And
Yeah.
at the same time, car prices could be on the rise. And that's according to Rella Suskin, an equity analyst at Morningstar, whose insights were shared in the CBS article. Now, in a Thursday research note, she pointed out that while US made vehicles might gain market share, very few are actually made with 100% American parts, even from US broadbands or basebands like you were talking about early, Tony.
Yeah, even US based car brands like GM, Chevy, Ford,
Hmm.
they do use parts from overseas or Mexico or Canada, and it seems to me like it seems that the news about tariffs and all the market upheaval, it's causing economic anxiety for a lot of people out there,
Yes.
and that's a good reason to kind of slow your roll, slow it down, and meet with a financial services professional before you make any emotional decisions. Because I know, Albert, you can help people stick to the facts and avoid those emotional decisions, right?
Oh, exactly, Tony.
Yeah.
I mean, you have to remember, investing is long term, and people should have an actual written financial plan.
Yeah.
So that way they can see where they are in this. But going back to the article, it also explains that the automaker shares, well, we know, took a hit after the news.
Yeah.
And the latest round of tariffs follows a temporary break President Trump gave U.S. automakers earlier this month and a 1 month exemption from the import duties that, well, started on March 4th. Now, here's what that means for everyday Americans. Tariffs are essentially taxes on imported goods. And most of the time, those costs gets passed right down to the consumers. That can lead families to tighten their budgets and potentially slow down economic growth. Now, Wall Street didn't waste any time reacting. Shares of Ford, GM, and Stellantis, the big three US automakers, all took a hit after Trump made that announcement. And then Ford dropped nearly 4%, GM fell more than 7%, and Stellantis led about 2.6% in that Thursday morning trading afterwards. Now, Tesla, on the other hand, saw a bump, rising about 2.6% after a heck of a rough start to the year. And
Yeah.
the company builds its cars in the US, which helped. But even Tesla isn't fully insulated. CEO Elon Musk said the automaker will still feel the effects since many parts do come from overseas.
Interesting. So, what's been the reaction to all this from the automakers out there?
Ah, Matt Blunt, president of the American Automotive Policy Council, that's the group representing Ford, GM, and Stellantis, issued a statement saying U.S. automakers remain committed to Trump's vision of boosting American made vehicles and jobs. But he also cautioned that any tariffs need to be rolled out carefully to avoid pushing prices even higher and then hurting the U.S.'s competitive edge in North America. So this move isn't new ground for Trump, as we know. He's long positioned auto tariffs as a cornerstone of his economic plan. So, banking on the idea that higher import costs will motivate both foreign and domestic car makers to shift production to the U.S. soil. But here's the catch: even US plants rely heavily on parts and vehicles from, like you said, Canada, Mexico, and beyond. And because expanding manufacturing takes time, experts say we could see domestic car prices rise and sales slow down before we see any long term benefits.
So, how much could car prices jump then?
Oof. Well, one recent analysis suggests these new tariffs could push auto prices as much as $12,200 on certain models.
Wow.
Now, according to the Anderson Economic Group, a Michigan based consulting firm referenced in the article, that tracks the industry very closely. Now, could this lead to more cars being built here in the US? Maybe over the long haul. But in the short term, it's likely to drive prices higher all across the board. Now, Paul Ashworth, who's the chief North America economist at Capital Economics, he puts it this way in the article. While the move might encourage domestic production down the line, for now, it's going to be inflationary. And if automakers hike their prices too, buying a new car could start to feel like a luxury purchase for many Americans.
Wow. So I think this is just all more of a reason that we need to get our financial plans in order, make
Yes.
sure that we're properly allocated, have good balance. How can our listeners get a hold of you to set up that no charge, no obligation consultation?
Yeah, folks, you can visit my website at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen, or call my office at 586-752-7008 and discuss how we can answer your questions and address your concerns about tariffs, market volatility, or any other parts of your financial strategy.
All right. Well, this has been a really good discussion so far. You talked about how this latest round of announced tariffs could impact our pocketbook as well as the broader economy. It's
Yes.
caused some ups and downs in the market, and it's been a good chat so far. What's next on the agenda, Albert?
Well, let's next examine what the fluctuating stock market could mean for your 401k.
Yeah.
So, a USA Today article titled Stocks Have Taken a Beating. What should you do about your 401k? Has some insights here. So, the stock market, which charged into 2025 like a racehorse gliding easily into the home stretch, now seems to be gasping for air. After I would say 3 straight weeks of decline, the S&P 500 has dropped 9.3%, with similar dips showing up in the Dow and other major indexes. So, if you got money in a 401k or let's say a retirement account, this recent roller coaster might have your nerves a little rattled. Well, that's totally normal, folks. These accounts are designed for the long haul. Remember that. So, short term swings aren't usually cause for panic. But if you're feeling uneasy, you're not alone. And we've got a few tips to help you step back, breathe, and keep things in perspective.
Well, yeah, for sure. And what reasons are there for the market's recent downturn?
Mm. What's behind all the market jitters? Well, in short, President Trump's push to impose tariffs on major trading partners like Canada, Mexico, and China. Now, tariffs, especially in the short term, can drive up prices on imported goods, and then often trigger retaliation against the U.S. exports, is what we're seeing now. And then on top of that, the administration's mixed signals on some proposals have created the kind of uncertainty that investors generally don't like. What's different this time, though? The president isn't ruling out the possibility of a recession. He's calling it a transition period as these new import taxes take effect. Now, to be clear, a recession isn't a sure thing, at least not yet. But if this tariff tension leads to, let's say, broader economic slowdown, well, it could take the conversation from cautious to genuinely concerning.
Well, yeah, and it is concerning for many. How bad is the current stock market? I mean, it's been down for days and took quite a plunge, but now today it's back up a bit. So, what do you think?
Well, Leah, everyone has to understand that this isn't a pullback because of economic numbers or market numbers. This is self-induced by our president because of the tariffs that he announced and enacted last week
Right,
on
it has
Liberation
no,
Day.
it has really nothing to do with the current
Correct.
state of the companies and their strength,
Correct.
right?
They're still bringing in profit, so be it that their outlook in the future might be a little lower now
Hmm.
because of these tariffs.
Yeah,
And that's what we're going to start seeing here in the next couple of weeks is all the first quarter reports of earnings. So that's going to help the market a bit. But right now, it's no time to panic. All right.
sure.
Though it's clear many investors are feeling uneasy, worried that things could get worse. But let's just zoom out for a minute. Since 1980, the S&P 500 has had an average intra-year drops of 14.1% according to JP Morgan Asset Management. Still, the market ended in positive territory in 34 of those 45 years. That's about 3 out of every 4. So, if I go back even further, since 1950, the S&P has delivered an average annual return of 11.6% despite plenty of nerve-wracking moments throughout the years. So, should you make a move right now? Probably not. Pulling money out of your account locks in the losses and could trigger the taxes. But if the swings are keeping you up at night, well, maybe it's time to revisit your investment mix. Now, the worst drop in recent history was a 49% plunge during the 2008 financial crisis, which we
Yeah.
all still remember.
I remember that one.
And since 1980, there have been 4 other years where the market fell 30% or more. And interestingly, in 2 of those cases, it bounced all the way back by year end.
And in all 4, it went on at some point to set record highs and be higher than ever and way
Correct.
more than make up for those drops. So that is good historical perspective. I mean, past performance isn't indicative of future results, but it is good that we have the past 100 years we can look at and say,
Yes.
okay, we've been here before. We've had corrections. We've had recessions. That's good to have that perspective. What's next?
Yeah, I mean, you're definitely right, Tony. Remember, we don't have a crystal ball for the future, so
Well,
we
wait,
have to rely on
you
the
don't have a
past.
crystal ball. I thought, why am I talking to you, Albert? I thought you did.
All right, so now let's consider how the current situation may affect your 401k. Lately, the stock market's momentum has mostly come from, let's say, a small group of tech giants, the so-called Magnificent Seven. Well, these companies have been driving much of the S&P's 500 growth, but that also means the index and any mutual funds tied to it have become more concentrated and less diversified. So, if you're looking to bring better balance to your portfolio, it might be time to think beyond big US tech. Consider adding investment options not tied directly to the S&P 500. Maybe some international markets can also play a key role in long-term diversification. And here's a simple shift to consider: blending in bonds. You know, last few years, bonds have had a tough rap because of the interest rate, but now they're starting to produce some yields. And a 60-40 mix, that's 60% stock and 40% bonds since 1950, that mix has averaged 9.4% per year, Tony. And according to the study referenced in the article. So past performance doesn't always guarantee future success, though. Remember that. And all investing involves risk of some type of loss. Okay.
Yeah. Well, and rebalancing your portfolio is a terrific reason to schedule that no charge, no obligation check in with a trusted financial professional. I know, Albert, you're more than happy to sit down with our listeners, talk to them about this if they want to set up a consultation.
Yes, for sure. For sure. Let's finish here and just talking about what the article notes is a possible to view current market losses in more of a positive light. And I want you to understand that. One way to stay grounded is to zoom out and look at the bigger picture. As we've said, the market tends to bounce around, but more often than not, it ends up higher over time. And that's what you have to understand is your financial time horizon. And chances are you're still close to where you were 3 or 4 months ago. So, in many ways, the market is just giving back some of the gains from that post election rally. Now, if you've got a 401k, here's another way to think about it. Your employer may match a portion of your contribution. That match acts like a little buffer, kind of like playing with house money, which helps soften the impact of short term losses. And now, if you're, let's say, in your 20s or 30s, boy, time is on your side. You can afford to take more risk, and a dip like this might even be a buying opportunity. But even if you're in your 60s and 70s, there's a good chance you've still got a decade or two ahead. So over time, the market tends to trend upward, and that long view can really work in your favor, Tony.
Okay, so Albert, how do you help your clients? Uh, how do you help them avoid making overly emotional decisions with their 401ks and their investments during a market downturn?
We for us, we supply what's an actual written financial plan. All my clients have a digital portal to their plan where it covers everything from taxes to inflation. And so we understand where they're going. And when we have a situation like this, what's nice is that my clients can get onto their plan, put that little loss in there, and then see how did that affect them in the long run. And most people still have money left over age 100. And because of knowing that, it's why they're not worried right now. And
Mhm.
so that is one of the biggest keys, having a written financial plan so you know where you're going or you know where to move because of that plan.
All right. So we're out of time for today's show, but let our listeners know how they can set up that no charge, no obligation consultation.
Yeah, folks, you can call my office at 586-752-7008 or visit my website at www.kaizenfinancialgroup.com. That's Kaizen, Kaizen, and discuss how we can answer your questions, address your concerns, and remember, it is our goal to help prepare for your retirement that you work so hard for so you can own your retirement.
Own your retirement. Thanks, Albert. And listeners and viewers, that does it for today's episode of Own Your Retirement with our host, Albert Lalonde.